When the stock market gets volatile, investors search for safety, treasuries, municipal bonds, stable assets such as those that pay dividends. But the 10-year, well, it's still trading right around 1.5% right now. And the 30-year, that's closer to 2%. Not a lot of yield for your safety there. Seema Mody is looking at the pros and cons of higher yielding preferred stock. This is we kick off a new series on CNBC called The Hunt for Yield. Seema.
Hi, David. The biggest ETFs invested in preferred stock saw their assets under management jump by 27% in the last year. Preferreds are issued by companies to raise money and trade under a different symbol than common shares. They've been a favorite vehicle for Warren Buffett, who bought Occidental Petroleum's preferred stock last year and famously scored big on preferred shares after getting a special deal that wouldn't be possible for smaller investors, with Goldman Sachs, Bank of America, and General Electric buying them up during the financial crisis. Now, preferred stock spits out dividends much higher than ordinary common shares. For example, let's run through the numbers on Bank of America. The common shares are paying a dividend of 2.1%. The latest preferred stock was issued last month, paying 4.3%. A September 2019 preferred issuance was offered to the market at 5%. Most of that was gobbled up by institutional investors, but individuals can get in on the action as well. Buying the preferred over the common shares would have given greater yield, but common shares have surged up 25% since September. Common shares of Broadcom, ticker AVGO, pay 4.25%. Preferred shares issued in September of last year were offered at 8%. Now, again, better yield, but in that time frame, Broadcom common shares are up about 10%. There are also ETFs dedicated to this space, fully invested in preferred shares like the iShares PFF, paying 5.25% annually. Now, if a company goes belly up, holders of preferred stock are second only to bondholders in a fight to get their money back. But critics argue the yield on preferreds don't give you enough of an advantage over even more secure high-yield corporate bonds. They say preferreds are only a good investment in a down market, which we don't have right now. They also limit your upside if common shares soar. Unlike common shares, preferreds can also call back by the issuer. And if you give up your right to vote like an ordinary shareholder, if these are a problem for you, you may need to continue your hunt for yield somewhere else. For more ideas in the preferred space, go to CNBC.com.